Valuation multiple. Why the same company gets repriced for those earnings. A company can keep growing, and the stock can still fall. That sounds unfair. But it happens because a stock price is not only about earnings. It is also about the multiple investors are willing to pay for those earnings. Think of the multiple as the market's opinion. If investors are confident, they may pay a higher PE ratio. If investors are nervous, they may demand a lower PE ratio. The business can be the same. The earnings can be the same. But the price can change because the market reprices the multiple. Here is the simple StockIQ frame. Stock price equals earnings power multiplied by the valuation multiple. If earnings go up and the multiple stays the same, the stock can rise. If earnings go up but the multiple falls, the stock may go nowhere. If earnings fall and the multiple falls at the same time, the stock can drop fast. This is why valuation matters. Not because a high PE is automatically bad, and not because a low PE is automatically good. Valuation matters because it tells you how much expectation is already built into the price. A high multiple usually says, the market expects strong growth, strong margins, strong execution, and a long runway. That can be fine if the company keeps delivering, but it leaves less room for disappointment. A low multiple usually says, the market is skeptical. Maybe growth is slow, maybe earnings are cyclical, maybe the business is under pressure. That can create opportunity, but it can also be a value trap. So never ask only, is the PE high or low? Ask, what growth is the market paying for? How durable are the earnings? Is the company becoming better or worse?
And what could cause investors to pay a higher or lower multiple in the future? Let's use a simple example. Imagine a company earns $10 per share. At a PE of 20, the stock is worth $200. If earnings stay at 10, but the market decides the company deserves a PE of 15, the price falls to 150. Nothing had to break in the quarter. The market simply paid less for the same earnings. Now imagine earnings rise to $12, but the PE falls from 20 to 15. The stock becomes 180. Earnings improved, but the stock still fell from 200. That is multiple compression. Now flip it. If earnings rise and the market pays a higher multiple, that is powerful. That is what happens when earnings power and investor confidence improve together. For a durable compounder, a premium multiple can make sense when earnings are recurring, margins are strong, and the runway is long. For a cyclical stock, a high multiple can be dangerous if earnings are near a peak. That is why StockIQ separates the business quality question from the valuation question. The company can be good. The stock can still be expensive. The company can be out of favor. The stock can still be interesting. Before buying, ask, what earnings power am I buying? What multiple am I paying? What would make that multiple expand? And what would make it compress? That is the StockIQ valuation multiple framework. Price is not just what the company earns. Price is what the market is willing to pay for those earnings. When that willingness changes, the stock gets repriced.